Hey there, curious minds. Welcome back to the deep dive. Have you ever, found yourself scratching your head, wondering why maybe your colleague's business travel money doesn't show up on their W-2, makes their income look lower, right? But then your phone allowance, that monthly payment from work, it just sort of magically appears as taxable income. It's confusing. Happens all the time. And today, we're pulling back the curtain on that exact tax mystery. We're diving deep into the really crucial differences between accountable and non-accountable plans. And understanding these, honestly, it could quietly save you or maybe cost you serious money when
Mhm.
tax season rolls around. But before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, the examples, explanations we talk about here, they're all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website. They've got extra practice questions, video lectures, detailed support. Great stuff to reinforce today's topic. And a special thanks to Professor Farhat for providing all this valuable material. Okay, so let's unpack this first big idea. We hear accountable plans thrown around with business expenses. What exactly is an accountable plan, at its heart?
Right. So at its core, an accountable plan is really just a formal agreement. It's between you, the employee, and your employer. And it's specifically for reimbursing you for expenses you rack up on behalf of the company.
Yeah.
It's not part of your regular pay or wages.
Okay, so things like work calls on my personal phone or driving my car for a client visit.
Exactly. Or maybe even setting up a home office because the company needs you to work from home. These are costs you pay up front, right? But they're really for the employer's benefit, not yours personally. So under an accountable plan, the company expects you to, well, keep good records, submit your receipts, other proof, and then they pay you back. Sometimes they might even give you money up front, like in advance, maybe $2,000 for a business trip you're taking.
In advance, okay.
Yeah, but here's the key bit. Even with that advance, you still have to provide that detailed report. Show exactly what you spent. And critically, if you spent less, say, only $1,600 of that $2,000, you must return the difference, the unspent $400.
You have to send money back.
You do. It's all about being transparent and having strict documentation.
Okay. So it sounds like a fair bit of careful record keeping, maybe sending money back. From my perspective as the employee, why would I want this? Why is it good for me considering all that, paperwork?
Oh, well, that's where the real magic happens for your personal finances. And it's why understanding this is so important. The main benefit, the big one, is that reimbursements you get under a proper accountable plan are not reported as extra income on your W-2.
Not income.
Nope. It's basically a wash for tax purposes. Think of it like this.
Yeah.
You pay the business expense. The company pays you back for that exact expense. And the money just passes through your hands. It never actually lands in your taxable income pile, as far as the IRS is concerned.
Okay, that sounds pretty good. A wash. I like that.
Yeah. And for the company, it's also a win. It's a totally legitimate deductible business expense for calculating their AGI, their adjusted gross income.
Right, that important number for their taxes.
Exactly. So it helps them too. It keeps things clean, ensures your taxable income reflects what you actually earned personally. It can save you maybe hundreds, maybe thousands each year. It's kind of a hidden perk if your employer does it this way.
That wash effect definitely sounds appealing. But you mentioned this applies to employees of S&C corporations. What if I'm, say, a freelancer or I own my own little business? Does this setup still work for me?
That's a really good question to ask because it does highlight that specific employee-employer relationship. It's an accountable plan structure we're talking about. It's mainly for employees of S Corp and C Corp. Those setups have that formal, legally distinct relationship.
Mm.
If you're an owner-operator or maybe a sole proprietor, where, in the eyes of the IRS, you basically are the business,
Yeah.
then your expense handling works differently. You typically deduct your business expenses directly on your Schedule C form, for instance, not through this employee reimbursement system. So yeah, this chat is really geared towards folks getting a W-2.
Gotcha. Okay, so for W-2 employees, that wash sounds fantastic. But knowing the IRS, there are probably some very specific rules to make sure this isn't just a loophole, right?
Oh, absolutely. You hit the nail on the head.
Yeah.
The IRS isn't just taking your word for it. They are quite strict. They want to be sure these reimbursements are genuinely for business costs and not just, disguised extra pay. So there are two core requirements, non-negotiable. You must meet both for the plan to count as countable. Miss one, and the tax benefit disappears.
Okay, what are they?
First one, substantiation of expenses. You absolutely must provide adequate evidence. And adequate means more than just like a credit card statement showing you spent money.
Right. Not just the amount.
Exactly. The IRS wants details, receipt showing the amount, the date, the place,
Okay.
sure, but also the specific business purpose. Why did you spend that money? And crucially, the business relationship of you, the taxpayer, to whoever else was involved in that expense.
So who you met with.
Precisely. Think about that Adam example we looked at from the lectures. He carefully sent in canceled checks for his travel and meetings, showed the place, the amount. He thought he was all set.
Yeah, sounds like he did his homework.
But nope, his deduction wasn't allowed. Why? Because he also needed to state the specific business relationship, who he met, what their role was, and the clear business purpose for that meeting or trip. Just proving you spent money isn't enough. You have to justify the why, the who, and how it directly connected to doing business. You need the whole story, documented. All those details are necessary.
Wow, okay. So it's not just, here's my receipt. It's more like, here's the receipt, here's why I spent it, who I was with, and how it helped the company. That's a lot of detail. What's a second strict rule?
The second one, and this is one that often tricks people up, is the return of excess reimbursement. This means if your employer gives you that advance, remember, the $2,000 for the business trip,
Yeah.
and you only end up spending $1,600, you must return that leftover $400.
Must return it. Not just like a good idea.
Right. Nope. It's a hard rule for tax purposes. If you fail to return the excess, even if it's just a small amount, the entire $2,000 you received for that trip, not just the $400 you kept.
The whole amount.
The whole amount becomes taxable income to you. It's a really critical point. It can flip what you thought was tax-free money into a big tax headache if you forget or ignore it.
Well,
It basically makes the plan non-accountable just for that reimbursement.
ouch. Okay. So the IRS is basically saying, look, if you want this tax-free treatment, prove it was only for real business costs and you didn't pocket any extra. That definitely sounds like a lot of receipts, careful tracking, which, let's be honest, can be a major pain, especially if you're busy traveling a lot. Is there any simpler way, especially for frequent travelers?
That's a great point. And yes, the IRS does recognize that saving every tiny receipt for coffee, taxis, meals, it can be an administrative nightmare. So there is an alternative specifically to simplify things for travel expenses. It's called the per diem allowance.
Per diem, I've heard that term.
Right. So instead of keeping every single receipt for meals, lodging, incidental costs while you're traveling on business, your company can choose to use a fixed daily amount. It's set by the federal government. The GSA usually publishes the rates. These rates vary by location because costs are different everywhere. So for Chicago, say, they might set a per diem rate of maybe $75 per day just for meals and incidentals.
Okay.
If your company uses this method, you just need to prove you were traveling for business on those days. You claim the per diem amount for meals for X days. No need to keep all those individual restaurant receipts.
Oh, that sounds liberating, especially for someone who travels a lot. No more stuff and crumpled receipts in my wallet. But what's the catch? I mean, if I end up spending more than the per diem rate, say meals in that city were just really expensive, am I just out of luck on the difference?
Yeah, that's the trade-off with per diem. It massively simplifies the reporting, cuts down the paperwork for everyone, but it does have that limit. If you actually spend more than the per diem rate allows for, say, meals, you can only get reimbursed up to that per diem amount. Unless you did keep all your detailed receipts for the higher actual cost and you choose to submit those instead of taking the per diem.
Ah, so it's one or the other.
Exactly. You can't double dip. Either take the simple per diem rate and ditch the receipts for that category, or keep all the receipts and claim your actual higher costs. Most people, honestly, if their spending is usually around the per diem rate, they just take the per diem for the convenience. It's a balance, right? Ease versus maybe getting back every single penny if you spend a lot more in a high-cost area.
Fascinating. So per diem means efficiency, but maybe not always full reimbursement if you go over.
Yeah.
Okay, now let's flip this. Let's look at the other side of the coin. What about a non-accountable plan? How does that work, and how is it really different from the accountable plans we've been discussing?
Right. So a non-accountable plan is pretty much what it sounds like.
Yeah.
It's usually an allowance the employer gives you, but doesn't require you to provide that adequate accounting, those detailed records we talked about. And crucially, it doesn't require you to return any excess amount if you don't spend it all.
So they just give you money.
Pretty much. The company gives you money, maybe a flat amount each month, and they don't really track how you spend it for specific business needs, or they don't require you to prove it or give back any leftover. Like they might say, here's $500 a month for your cell phone and home internet use for work. No receipts needed.
Okay, so up front, that sounds, well, less hassle, right? No receipts, no sending money back. Maybe sounds even better to an employee. But what's the catch? What does this actually mean for you, the employee, when tax time comes around? What's the hidden cost here?
You're right, it sounds less restrictive. But, and this is a big but, it comes with a significant, often unseen downside for the employee tax-wise. Any money you receive under a non-accountable plan, it is included in your gross income. It gets reported right there on your W-2 as regular taxable wages.
Oh, so it's just treated like salary.
Exactly. So that $500 monthly allowance for phone and internet, that adds up to an extra $6,000 on your annual taxable income reported on your W-2. It's like your salary just bumped up by $6,000. But you can't actually keep that extra money because it's supposed to be covering those expenses you're incurring.
Right, you still have to pay the phone bill.
You do. And here's the kicker. While the company still gets their deduction for paying you this allowance, it's a wage expense for them. You, the employee, generally cannot deduct the actual business expenses you paid for with that allowance to offset the income.
Wait, really? I can't deduct what I actually spent.
Not anymore for most employees. Before 2018, you might have been able to deduct some of those costs as miscellaneous itemized deductions on Schedule A, subject to certain limits. But a major tax law change, the Tax Cuts and Jobs Act, suspended those unreimbursed employee business expense deductions from 2018 all the way through 2025.
Wow, okay, so that's a big deal.
It's huge. It means if you get that $6,000 allowance under a non-accountable plan, and let's say you genuinely spend $5,500 of it on legitimate business costs, you're now stuck paying income tax on the full $6,000 with no way to deduct the $5,500 you actually spent for work.
So you pay tax on money you never really kept.
Precisely. Think of your paycheck like a pie again. With a non-accountable plan, your company adds an extra slice labeled expenses, making the whole pie look bigger to the IRS. But then the IRS says, sorry, you can't take out the part you actually used for business. So you pay tax on that whole extra slice even though most of it just passed through your hands to cover a work cost. It's a really significant, often overlooked hit.
That is a powerful way to put it. Paying tax on money that was just covering a cost, that definitely changes how you feel about getting that allowance. And I guess this ties back to what you said earlier about how even a good plan, an accountable one, can sort of default to this bad treatment.
Absolutely. That is the critical warning here. And it's where a lot of well-meaning employees can accidentally get into trouble. Even if your company sets up an accountable plan with all the right intentions for tax-free reimbursements,
Yeah.
if you, the employee, fail to follow the rules of that accountable plan.
Like not returning the extra money or losing receipts.
Exactly. If you don't return the excess when you should have, or you don't provide that adequate proof, those specific reimbursements can be reclassified by the IRS. They'll treat them as if they came from a non-accountable plan, and boom, suddenly that money becomes taxable income on your W-2, even if the company policy calls it an accountable plan. Your personal compliance, following your company's specific reimbursement policy to the letter, it directly impacts your own tax bill. Just forgetting receipts or not returning that small amount of extra cash can cost you real money.
Wow, okay, that really brings it home. It's definitely not just about getting the money back. It's about how that money is classified and the tax impact. So just to recap quickly, accountable plans follow the rules strictly. Keep records, return excess, and the reimbursement is a tax wash, not income. Non-accountable plans or accountable plans where you don't follow the rules, that reimbursement becomes taxable income on your W-2, and you probably can't deduct the actual expense anymore.
You got it. That's the core distinction. And it's super important if you incur any kind of business expense for your job. If we kind of step back and look at the bigger picture, understanding which type of plan your company uses or how they handle your specific reimbursements is just crucial for your personal tax planning and your overall financial situation. Which I think raises a really important question for everyone listening. Are you really clear on how your employer handles your business expenses? Do you know if it's accountable or non-accountable?
Exactly. It's all about being informed, being proactive, making sure that money meant to cover work costs doesn't accidentally turn into a personal tax burden. So, here's a final thought for you to chew on. How can you proactively make sure your business expenses are handled in a way that helps, not hurts, your tax situation? And maybe, what specific questions should you be asking your company's accounting or HR department to get crystal clear on their reimbursement policies? Definitely worth finding out. Your wallet might thank you later.